Maryland Economy is a podcast authorized by Sonia Dunn for Maryland, Brittany Garrett, Treasurer.
I am Sonia Dunn, and this is Maryland Economy. Today, we're discussing one of the most significant tax policy changes enacted in recent Maryland history, the 3% tax on information technology and data services, commonly known as the technology tax or tech tax. Supporters argue that the tax would modernize Maryland's tax code and generate hundreds of millions of dollars to help close that state's growing structural deficit. Critics warned it would increase the cost of doing business, discourage investment, and make Maryland less competitive. Nearly a year later, we can begin evaluating the results. Has the tax delivered what was promised? And what does it mean for Maryland's economy moving forward? Should it be repealed? So let's get into it. I'm going to break it down into 8 key points. Number 1, what is the sales tax? As part of the 2025 Budget Reconciliation and Financing Act, Maryland imposed a 3% sales and use tax on certain information technology and data services beginning July 1st, 2025. The tax applies to a broad range of business-to-business technology services, including software publishing, cloud computing, data processing, hosting services, and IT consulting and systems design activities. This tax has an impact on the majority of the economies in Maryland. State leaders adopted the tax as part of a larger package designed to address a projected budget shortfall of approximately $3.3 billion in 2025, with the support and the blessing of the Maryland's Board of Revenue Estimates and the Office of the Comptroller of Maryland. No pushback whatsoever. The technology tax was estimated at the time to bring in over $500 million annually. That's right, $500 million annually. And we'll get into that a little bit more later in the podcast. Point number 2. Maryland is not the only state that taxes software or digital services. More than 20 states tax some form of software as a service or cloud-based technology, while most other states either do one of 3 things. 1, tax software under their existing sales tax structure. 2, tax all services broadly. Or 3, do not tax software as a service and cloud services at all. Maryland's tax law taxes business-to-business IT and data services used by companies at 3%. Most importantly, it is highly unusual for a state because it specifically was put in place as a revenue source to help close the state's budget gap. The real question is not whether other states have technology taxes. The real question is whether Maryland's version is generating enough money to justify its impact on businesses, innovation, and economic competitiveness. Number 3, who is really paying the tax? Despite its nickname, this is not simply a tax on technology companies. Let's face it, technology has become a basic operating expense for nearly every organization. A local contractor using project management software, a doctor's office relying on cloud-based records, a nonprofit managing donor databases, a manufacturer using data hosting and cybersecurity services. Better yet, a small business using accounting and payroll software. All may ultimately face higher operating costs when technology vendors pass the tax through to their customers. And who are those customers? Maryland businesses, Main Street, mom and pop shops, all trying to stay afloat, modernize with technology, and not get left behind. Business organizations and advocacy groups across Maryland warned that the tax would affect virtually every sector of our state's economy. And it has. Number 4, the promise. When lawmakers approved the technology tax, it was projected to generate approximately $500 million annually for Maryland in fiscal year 2026. The revenue was expected to become a major component of the state's long-term budget plan. Supporters for the technology tax argued that Maryland's tax structure had not kept pace with the modern digital economy, and that expanding taxation to certain digital services would provide a new, stable form of revenue for the state. That was the promise. We were promised $500 million annually to reduce Maryland's structural deficit. The question now is whether those projections were accurate. I think we all know the answer to that, but I'll talk about it in a moment. Number 5, the reality. As revenue data becomes available during fiscal year 2026, Maryland's own revenue forecasters significantly reduced expectations. So no, we're not going to hit the $500 million mark. According to reportings even by Maryland Matters, the technology tax was originally expected to generate roughly $500 million, but early collection was running as much as 90% below original estimates. Another outlet called Technically reported that the tax revenue generated only $35 million during the first half of the fiscal year of 2026, causing the state to lower expectations of its annual collection from nearly $500 million to approximately $110 million. Because of the performance of the tax, Board of Revenue Estimates had no choice but to revise its projections downward, reflecting substantially lower collections than originally anticipated. And remember, the Comptroller of Maryland sits on this board. Regardless of where you stand politically, these revised financial forecasts raise legitimate questions about the assumptions used when the tax was enacted, with the information from the Board of Revenue Estimates that was given to the Department of Legislative Services to assist the Maryland Assembly with the viability of this tax for Maryland. Point number 6, the economic concerns. There are 3 major concerns surrounding the technology tax. 1, higher costs. Technology is no longer optional infrastructure. Businesses today depend on software, cybersecurity, cloud services, digital communications, and data management systems. When government increases the cost of those tools, businesses often respond by reducing spending elsewhere, delaying investments, increasing prices, or slowing down hiring. The second major economic concern is competitiveness. Maryland competes every day with neighboring states such as Virginia, Delaware, and Pennsylvania, North Carolina, West Virginia, and Florida for businesses, entrepreneurs, and investment capital. When companies evaluate where to locate employees, launch startups, or even expand operations, tax policy matters. A state that imposes additional taxes on technology services risks becoming less attractive related to competitors. Business groups warned about this possibility throughout the legislative process in 2025. The third major economic concern is outmigration. Maryland has already experienced concerns regarding population loss, taxpayer migration, and businesses relocations within the past recent years. While no single tax causes a family or a company to move, economic decisions are often cumulative. Rising taxes, increasing fees, higher operating costs, regulatory burden collectively influences where people choose to live, work, and invest. The technology tax adds another cost layer to an already challenging business environment, particularly for startups, small businesses, and technology-dependent industries. Point number 7, should the tax be repealed? This is a policy question Maryland lawmakers will likely continue debating. Given the substantial gap between projected and actual collection, Maryland should seriously evaluate whether the current structure is accomplishing its intended purposes. If a tax was expected to generate approximately $500 million, but is now projecting to produce closer to $100 million, policymakers have a responsibility to review the program and determine whether it still is sound fiscal policy that remains on the backs of Maryland businesses. From my view, Maryland should pursue one of 2 paths. First, repeal the tax entirely and replace the lost revenue through spending reforms, operational efficiency, but mainly economic growth. Or, number 2, substantially restructure the tax by exempting small businesses, startups, nonprofits, healthcare technology, educational technology, cybersecurity services, and other substantial business functions. What Maryland should not do, what everyday taxpayers should not do, what Maryland lawmakers should not do, and especially what the governor should not do, is ignore the data. Good fiscal policy requires measuring outcomes, not intentions. Point number 8. The bigger issue. The technology tax ultimately highlights a larger challenge facing Maryland. Maryland does not have a technology problem. Maryland has a structural spending problem. Long-term fiscal stability cannot be achieved solely through new taxes and fees. Sustainable revenue growth comes from a growing economy, a strong workforce, thriving businesses, and strong financial management. If Maryland wants to strengthen its finances, we must focus on creating an environment where businesses choose to invest, innovate, hire, and stay. Economic growth, not economic drag, should be the goal. And right now in Maryland, we are experiencing an economic drag. So those are my 8 points. But before I get out of here, let me just say this one thing. The technology tax was introduced as a solution to Maryland's budget challenges. Nearly a year later, the evidence suggests that the tax is generating significantly less revenue than originally projected, while increasing costs for many Maryland businesses. Everyday Maryland taxpayers, that includes Maryland businesses because they're taxpayers, deserve transparency. They deserve honest forecasting. They deserve a government willing to evaluate whether policies are actually working. As taxpayers, business owners, workers, and voters, we should continue asking the simple question. Is this tax making Maryland stronger, or is it making Maryland more expensive? That's a conversation worth having. I'm Sonia Dunn, and you've been listening to Maryland Economy, and my sole purpose is to make sure Maryland's money is managed right. So from the shores to the mountains, from the Bay to the Beltway, we are Maryland strong. But it's time for Maryland to stand up for true transparency in regards to how we spend our money.
Maryland Economy is a podcast authorized by Sonia Dunn for Maryland, Brittany Garrett, Treasurer.